Hello, and thanks for joining us today for ACI Learning's Audit webinar. Have a question? Use the GoToWebinar question box and we will answer as many as we can at the end. Now let's get started.
Hello and welcome to ACI Learning's webinar series. We are so glad that you've joined us. Now our presenter today is Trent Russell, and he's here to talk to us about audit data analytics, and he's with Dr. Hernan Murdoch. Trent graduated from the University of Alabama with an MIS degree, and he's also the founder of Greenskies Analytics. Prior to starting his own company, he worked with Ernst & Young's IT risk assurance practice and served multiple industries. He also worked in the financial service office at EY and facilitated the development of data analytics procedures. In his current role, he helps internal audit launch their data analytics, get actual results, and move up the analytics maturity model. Hernan speaks at conferences in the United States and abroad. He's the author of numerous articles and books on a variety of topics, including internal audit fraud and more. He holds professional designations as a CIA and CRMA, and he currently serves as our Vice President of Audit Content here at ACI Learning. Prior to that, he was a senior project manager leading audit and consulting projects for clients in the manufacturing, transportation, high-tech, education, insurance, and power generation industries. So, what exactly is ACI Learning? ACI Learning trains leaders in audit, cybersecurity, and IT, and we deliver lifetime learning to over 250,000 engaged students, professionals, and organizations across 6 continents. Many of you attending today may know or have heard of MIS Training Institute, or MISTI. MISTI has been training auditors, risk and compliance fraud, and information security professionals worldwide for over 40 years. MISTI is now part of and is rebranded as ACI Learning. Check us out at acilearning.com and follow us on your favorite social media. We'd love to get questions from you as we go along, so please use the question panel in GoToWebinar on the right side of your screen, and we'll get to them after the presentation. This webinar is being recorded, and a link to the recording will be sent to you within a week. You can also download today's slides and any additional handouts by clicking on the links in the handouts panel. Now, let's welcome Trent and Hernan to today's webinar. Thank you for joining us, guys. Where would you like to begin?
Hey, everyone. Thank you very much for being here. Thank you for the folks at ACI Learning. There is a lot of them. So if something goes wrong or seems incorrect, it's most likely on my end. So they've been fantastic to work with over the past couple of weeks. The reason I like this session so much is for a couple of reasons. I attend a lot of these types of trainings also, and especially when it comes to the analytics ones. I mean, going back 10, 15 years, I always wanted to know, okay, how do you actually do that? Like, you're talking about this thing in theory, and that's great and wonderful. Can you show me how to actually do it? And so that's where a lot of my sessions, like, that's why we talk about how to actually do it. And so that's a key piece for any session that I do. The other reason I like this one in particular, in this particular technique or test, is you can use it on pretty much every single audit, especially if there's any transactional data within that audit. You can use this. So basically, at the end of this session, there shouldn't be an excuse for not being able to use analytics to some degree on pretty much every engagement. The last, and maybe even the biggest reason I like doing this one is because it hits on the 3 kind of foundational elements within actually like executing on analytics, and that is aggregating data. So in this example, we're going to talk pivot tables, joining data together. And so in this example, we're going to use VLOOKUP. You could use XLOOKUP. More advanced might be index match. So that's something you could look into. We're not going to hit on today. And then just any of the functions or the functionality within a given tool. If you can Google how to use that, then you can figure it out. And that's going to be able to solve 95% of the problems, at least when it comes to execution, that you're gonna see with analytics. And I'm going to do this in Excel because everyone has Excel. If you don't have it, well, if you have it in a more advanced tool, then you should be able to take the steps that I'm going to show and script those out in your tool or develop them into a workflow. So I'm going to share my screen. And so the particular technique that we're going to go over is called the Z-score. And the way I like to lay these out is, I know there's people here who don't really care about how to actually do this, totally fine. So we might have more senior manager level folks or even the CAEs or something to that effect. And so the way I like to line these up is this is why it matters. This is how you can see how to use it. This is how you actually do it. And then again, I'm going to re-emphasize this is how you can interpret these results and why it should matter. So overall, what a Z-score does is it identifies outliers in your data. And so if we can find the outliers in our data, then at a minimum, we'll be able to go back to management and go, hey, did you know this thing was going on? Did you know that you have a significant outlier here relative to the rest of the population? And even if they come back and go, yeah, we totally know about that. I mean, it was, $1 billion transaction or whatever it may be. Yeah, we know about that. Or maybe they didn't. But even if they do, they look and go, okay, well, you clearly are taking a different approach than what we're used to in working with audit. You're asking us these questions that we don't typically get. And so if nothing else, one of the biggest soapboxes I get on is, as fantastic as technology is and data in general, what it really allows for is significantly better relationships, which we absolutely have to have. And so if you can build a relationship while using these types of techniques and use analytics, then it's only going to make the audit function stronger. I will give I feel like obligatory, like Webster's definition of a Z-score. It is the number of standard deviations by which the value of a raw score is above or below the mean value of what is being observed or measured. And I'm sure for most people that means absolutely nothing. Doesn't matter. I'll show you. All right, so here we have AP data set for this particular company. They have multiple orgs. Within each org, multiple departments. Within each department, multiple account numbers. You can think about account number as something like, if we're looking at facilities management, it could be something like renting a large piece of machinery to do some kind of work on a building or outside, et cetera. All right, so we have multiple orgs with multiple departments, multiple account numbers. And so what we want to do is we want to be able to say, hey, look, for this given org, department, and account number, we see that the average price of that thing or service is $100. For whatever reason, we see that this one was $4,000 or whatever the number may be. Hey, can you help us understand why we see such an outlier relative to those? And then that's the question that we can ask. And so that's the importance of this. And that's why, and Z-score is a technique for identifying outliers. It's not the only technique for identifying outliers, but certainly one. And so it's about as easy as I could possibly think of how to show that. And so in starting with, I talked about the three pieces, right? Aggregating data, joining data, and then using the functionality within the tool or the functions within the tool. And so one of those functions within Excel anyway, is this concat function. And so what we want to do is enable, in order to look at the outliers within a given org, a given department, and a given account number, we have to create this key. Now, if you only want to look at it at a given org level or a given department level, you wouldn't have to do this step. So you could skip this step and just do the average invoice amount and find the standard deviations. And so the next thing I like to do, so if we drag that all the way down, when you're working in Excel, if you've ever had that issue where like it spins and spins and spins, maybe a lot of times it happens to me when I do VLOOKUPs, for example. And it'll just spin and get hung up. So a little tip is if you copy and then paste values, you can see now that the formulas are no longer in here. So that'll make it a little easier on your machine to be able to do this. All right, so now that we have this key, we want to insert the pivot table. So that's the second piece when we're talking about aggregating. And I will suggest, if you are not familiar with pivot tables, or if you are hesitant to jump into them, or you've tried it before and you had issues, if you take 20 minutes and watch YouTube videos on pivot tables and then just pull any data set that you have access to, doesn't really matter what it is, and just kind of follow along, it will save you hours and hours and hours of time. And you can get insights as well from doing this. All right, so we're going to grab our key down here. So now we have a unique list of each one of those org, department, and account numbers. And then we're going to grab the amount. And when you're working with numerical data in Excel, it's going to default to the sum. I don't really care about the sum. Recall, we want the average and then the standard deviations. So this is where a lot of the magic can happen in a pivot table, is down here in this values section. Click the drop down, value field settings, and then we can pick whatever we want to. So we want the average for each one of those as opposed to the sum. Obviously, you can do counts, the max, the min, product, et cetera. And there's a bunch of other ones in there. And then also, just if you're playing around with pivot tables, go to the show values as. You can play around with that also. All right. So now we have the average for each one of those. We also need the standard deviations. All right, so now we have the average and the standard deviations for each one of these. Where you're seeing a 0, and I'll zoom in a bit. Where you're seeing the zeros, that's likely a sign that there's only one transaction for that org department and account number. So since there's only one, you can't have, you have 0 standard deviations. And you'll see if it pops up in the example that when we ultimately try to do this to find the z-score, we're going to get division errors because it's going to try to divide by 0. Obviously, you can't divide by 0. All right, so now we have that aggregation piece that I mentioned. So now we need to bring the data from our pivot table into this workbook, or you could consider it a table if you're thinking database wise. A lot of hardcore analysts will say Excel is not a database, and no, of course it's not. But in thinking about in SQL and other tools, joining data together is the technical term. This would be similar in that we need data from one table or one sheet to be brought into another table or sheet. So what we're going to do is run this VLOOKUP. And the VLOOKUP is going to say, hey, anywhere where you see this value. Now I'm going to click back over in our pivot table. In this column, we want the value in the second column from there. All right, so if we went and copied this, let's do this real quick. We see 1021,435. We come over here, find that value, 1021,435. Next, well, we'll drag this down. Again, copy, paste values. And we're going to do the exact same thing here. We look up on this one, except instead of getting the value in the second column, we want the value in the third column. So we tell it, give us the value. So we'll type the 3, value in the third column. I'm not going to do that find exercise again. Hopefully you trust me enough by now. That worked. All right, so now I think we still have these VLOOKUPs in here in the standard deviation. So we'll copy and paste those. Like I said, usually it's the VLOOKUPs that tend to give you problems. Also, if you ever use conditional formatting, especially if you're looking at duplicates, you can like select this and find duplicates in here pretty easily. That'll tend to hang it up pretty well. So, okay, the last piece is basic math. We take the total transaction amount minus the invoice amount and divide it by the standard deviations. Here we have a -1. Pull it down, copy, paste values. All right, so this is the piece. All right, that's how you actually do it. And so if you were like, I don't care about that, totally fine. This piece, the next, is where we tend to see there'd be a little bit of a drop off in terms of internal audit. And what happens is, and not just internal audit, I shouldn't have said that, not just internal audit, it's literally a problem with every organization. If you hear about them being data driven, especially like those are the ones that have tried to solve the problem. Some have been successful. I think it's something like 25%. The Fortune 500 claim to be data driven, but it revolves around data literacy. And so what happens is people get the results of the analysis. They don't know how to interpret them.
Trent, quick question. So when we're looking at the Z-score, it seems to me like that is one of the ways that we can apply risk-based auditing, because what you're looking at is which value is going to be so anomalous in relation to the average that you say, okay, this one is, from a risk perspective, it stands out. There's something odd about this particular figure, and I can go looking for it. So you're not only checking controls, you're looking for risk, really.
100%. You said it significantly better than I did. Thanks for the spot there. That'll probably be a common theme where I say something and Hernan comes in and says it significantly better. So, so all we have to do is, once you get to this point, is any Z-score greater than, we'll do greater than or equal to 2.5 is considered an outlier. And I'll demonstrate that here in a second and why. Quickly though, because I don't want to get stats heavy on you, 2.5 means on a Z-score, 2.5 standard deviations away from the average. So if we went back to that technical definition, that's where it ties in. And so that's roughly, if we're 2.5 standard deviations away from the average, that represents roughly the top if it's a positive, or bottom if it's a negative, like 1.5% of the population. And so that's why it would be considered an outlier. So we will pick, what's a good one? We'll go with this one. And I'll highlight it for you all. All right, so we can see the total amount for this one, for this given org department and account number on this invoice is $4,942. If we look at the average, it's 301. The Z-score is 5.78. So you can see, even if like Z-score and stats and standard deviations, you're just like, I could not have cared less about anything you just said. If you just look at that logically and go, okay, on average for this, it's $301. For some reason, this one is $4,942. It's pretty obvious that that's an outlier. And so you could go back again to management and go, hey, can you help us understand this? Were you aware of this? Why is it going on? Dig into it yourself and see what's going on there. This can find fraud for sure, but I think that's almost a misconception with internal audit and analytics, is that like everything is about finding fraud. It's certainly a way to find fraud, and I guess you could look at it as a benefit of analytics, but that's not necessarily the goal here.
Another thing, to your point, it seems to me that if you're thinking in terms of the expense, right, like this we're talking about either accounts payable or T&E, you can say, for example, well, is anyone paying more than what everybody else is paying? Are they potentially, let's say, abusing the policy, or are they being careless with airfare, with car rentals, with hotels, with meals? They're just paying more than other people, which may not be fraud, to your point. Mm-hmm. But what they're doing is they're basically wasting money.
Yep. And so for that example specifically, what we could do is, instead of looking at it by org department and account number, if we just looked at it by account number, or if we just look at it by expense type, if we're talking T&E, then we'd be able to see like, hey, the average for a flight maybe is X amount. And we see all these flights are for more than that, because maybe they're first class or whatever the case may be. And that's what, I don't know, you could call a teachable moment even, to go, right, hey, maybe let's kind of reel that in a little bit next time. So, All right, so I'm going to stop sharing now. We'll jump back to the deck. Okay. And this is going to feed into, so we just did the Z-score. We're going to feed into this next piece with the Z-score a little bit. We're going to save it for later. But like I said, I understand some people are going to be looking at this for these next couple slides, what we refer to as the Cadillac of internal audit analytics, and go, don't care how you implement it. Don't care how it works in the back end. Just need to know the results and what that looks like. So ultimately what we're going to do here, we're going to use P-card as the example. So your purchase cards, your corporate credit cards, et cetera. And we are going to risk rank every single transaction through a series of, in our example, we're going to do 3. Real life, real world situation, look to do upwards of 20 to 30, 20 plus would be the recommendation. And so what we're going to do is, instead of taking the benefit of this, instead of taking a random sample of whatever your methodology says, 25, 60 transactions, and testing those attributes, what this allows you to do is go, here are the, in order, here's the highest risk transaction out of all of them. Let's say, we've done this with 10, 20,000 transactions at a time. Here's the highest risk transaction. Here's the second highest risk transaction. Here's the third highest risk transaction, et cetera. And so what you can do is once you build this out and implement it, you can, on a totally up to you, quarterly, monthly basis, go, hey, let's take the top 10, 15, 20, X amount of transactions, take a deep dive into those because we know those are the highest risk ones. And so if you're looking at your screen now at the deck, what you'll see is in that first column, the transaction number. So we're just doing a sample. I don't think anybody wants to see a slide with 10,000 transactions listed on it. So here's just a sample of 5. And then we have a sample of 3 tests. If we could go back one slide. And we have, sorry, it's on there now. If we have our sample of 3 tests, so again, I recommended north of 20 as a recommendation. Here we only have 3. And so let's say that first test is something like, hey, we have this transaction that came in. We want to know if it's a high risk MC code. So those are codes that you can typically get from your card provider that will say, it'll include like 4-digit number that goes, hey, this is tied to a given airline. This transaction's tied to a casino. This one's tied to a strip club. This one's tied to a bar. This one is for office furniture. And then based on your organization, you can go, hey, if one of these comes across, if we see our card used at one of these types of businesses, then that would be considered high risk. And so for most people, if you use your corporate credit card at a casino, it's probably not a good thing. Some areas probably okay in situations, but certainly something that most people would want to dig into a little bit. And so let's say that first example is a casino. So we go, hey, anywhere you see our card used at a casino, give it a risk score, or what we have in here is a weight of a 9, because that's a pretty high risk transaction for us. All right, so now we have that 9. We'll go to the next one and we say test 2 might be something like weekend transactions or off hours or after hours transactions. 20 years ago, that was maybe 30 years ago, that was kind of a big deal. Like, who's doing that? Why would you not do that during office hours? Obviously, given remote work and other factors, that's not super uncommon today. And I would say I know we've run this in the past, that one test hit more than any other test that we did. And I forget the numbers, but I remember looking at it going, yeah, there's significantly more off-hour transactions than there are any other relative to the test that we had defined. So anyway, let's say that's low risk now. So we'll give it a 3, but we still want to account for it. And then let's say test 3 is something like taking cash out of an ATM. I will say I've never seen a P card that was allowed to do that. But let's just say that it's possible. And in this case, for transaction 1, they took out cash on that card. And so if we add that 9, 3, and 6 together, we get that total quantitative risk weight, not super easy to say, of 18. And so imagine if we ran this for our 10 to 20,000 transactions, and then we sorted them highest to lowest, and now we know the highest risk transactions that we should look into. All right, so that is a piece of it. Go ahead.
Now, Trent, one of the things that I also like about this is the fact that a lot of auditors struggle with subjectivity with their risk assessments and being able to demonstrate how they are, number one, risk-based, but number 2, objective in their selection of transactions to review. So what you're basically showing is how we can eliminate some of the subjectivity, use a quantitative model, and be able to apply it en masse, really, because you can extend it, like you've been saying, 10,000, 20,000, you can do 100,000 or 1 million if necessary, and you are able to apply the formula throughout. So that is really going to be very powerful enhancement to a lot of people's methodology.
Right. And if you just so I said there's 3 steps. If you just take that first step, implement it, don't do anything else, you'll be in pretty good shape. And by good shape, I mean, even compared to other internal audit departments, the ones, that we talk to, if you just have that, you're going to be ahead of, if we talk about the maturity model, you're going to be moving up it quicker than most. So that is the first step into that. So if we look at the second slide, the quantitative piece of that. So this is where that subjectivity comes into, it's not as subjective here. But we're looking at it now, the quality of the transaction. So if you're looking at the screen, look at the last one. We have the organization level. And so here, the internal audit department. And let's say, hey, if it's coming from the internal audit department, maybe it's not that big a deal. We'll give it a 5. And if we see that it's coming from the category of a travel transaction fee, not that big a deal, it's a 5. You'll see those all the time in a P card for a lot of organizations. $16 travel transaction fee. Every time somebody books travel, there's a fee. You see those all the time. And then the next piece, the business activities, travel, training / education. We as internal audit typically travel to get our CPEs. We go to conferences, et cetera. And so it's like, that's, usually that's not a high risk situation. So we'll give it a 5. And so now we can take those, add those together. And now we get the 15 that you're seeing there. And so if we go to the next slide. So what can happen is, and I'll show the formula at the end. So we've done quantitative, let's say we did quantitative, qualitative, and now the Z-score piece. And it all fits into an equation, a very simple equation at the end. And so now we can use the Z-score and go, hey, look, if we have, let's say, our total risk score for a given transaction, both are, 200. The score is 200. But we have these transactions. One is for like $4 and one is for like 400. Do you really care about the $4 one that much? Even though it hits all the high risk transaction tests, if it's for $4 compared to 400, the 400 one's probably going to top the risk scale there. And so this helps create that separation a little bit. And so that's, again, another reason I like hitting the Z-score piece of that first, because I think if I just said Z-score without going into how that actually works or how to do it, it can get a little complicated. And so if we go to the next slide, we'll show the full equation. And so here is the full equation. So for our sample of 5, you can see that quantitative risk score that we talked about, the amount weight or the Z-score from the previous slide, the qualitative risk score. And if you plug that into the formula, it gives you the overall risk score. And then that max risk score is going to change each time you run this. So if you run it every quarter, there might be a transaction. The highest risk score for that given quarter might be 250. The next time you run it, it might be 137. All right. And so we take that, divide it by that max score, and then we get that final risk score. And so I'm going to share with you now what the output of this could actually look like. Again, I'm going to stick with Excel. We all know and love Excel, or at least know it. All right, so this is what the output could look like. And for the most part, this is actual data with exception to the last name. So this is cardholder last name. It was actually, I think it was the cardholder card number is what we have in here. So that makes it a unique identifier most of the time. Quick note, first thing you should do is, if you're gonna do this, check to see that you have unique card numbers for each person that's a card holder. You usually only get like the last 4 digits of that card. And so I have seen it where you will have the same last 4 digits twice associated to 2 different folks. So that's something to keep in mind, because when you go to aggregate these, if you do it by card number, you might get a score that adds up for 2 instead of the 1. So anyway, but these are real. So this Smith person is a fake person, but the name is, but this was the top 2 highest risk transactions on this run that we did was the same person. Let's say the last 4 digits were 8873. So we just came in for demonstration purposes, replaced those with Smith. And then another thing I like to do at the beginning of an analysis is apply a record number. It just makes it easier to go, hey, record 7425 than it is to go, hey, credit card number 4207, last name Smith. It's just an easier way to ID it and communicate it.
Trent, another thing that I'm wondering about is, as you're looking at some of the names, and I see that one of these is repeated there for a number of different reasons, but I guess one of the cleanup things you probably want to also look at as you're setting everything up is determining whether or not someone has multiple cards.
Yeah, absolutely. Yeah, and so you could aggregate those together. That's not uncommon to see where you have one person. Usually, it's like a department head might have their own card, and then this is the other piece you have to look out for. They might have the department card, and so identifying who those people are, and you might have to manually add that. It might not be in the data set already, but definitely something to keep an eye out on. Excellent point.
Or for split transactions as well. Yeah. Okay.
Oh,
This
yeah,
is good.
even better. Even better. And so we have the total quality score, the total quantitative score from our previous slides, and then the total risk percentage for each one of those. And there's a couple things you can do with this. Like once you, as maybe the operational auditor, so let's say that the data team or the analyst or whoever built this whole thing, and this is what you get. Like you don't care about all the other stuff that we've talked about. This is what you get. There's a lot of good stuff you can do once you get this file. And so if you understand it enough, and this is where the data literacy piece comes into play, you can go, I don't really care about the quality score as much, but this quantitative score, like I'd be curious, this one is let's see, let me highlight this. This one has a quantitative score of 64, but isn't super high on the list. Looks like it's number 12. And say we only take 10 maybe every month instead of 25 every quarter, whatever. Just play around with it and see if there is anything there, take 3 to 5 minutes and look into that one a little bit. Something you could definitely do. The other thing you could do, and so we're doing this by transaction. Another way you could do it is by the individual employee, or you could wait till you get to this point. You could also develop this to where it does it for both, but as an example of, hey, here's the results. Now you go play around with it. You apply your judgment. You apply your knowledge of that given area that you are more of an expert on than probably the analyst because you're the one doing the audit. You can come in here and let's throw this into a pivot table. And what we're going to do is we're going to say, hey, for each one of these employees or card numbers, I want to know who has the highest risk score per employee rather than per transaction. And that's where you can really kind of narrow down the potential fraudsters. All right, so this is going to sum it. If you'll give me 1 second to copy and paste this and sort it. All right. I'll zoom in even more. Okay. So you might recall Smith had the top 2, and then I think he was in there a couple more times within that top 10, or at least the view that you could see. And so you can see Smith has a total score of 5.43, Davis with a 4.3, and everything else is less than 1.58. And so even if you think about the Z-score piece, like if we applied the Z-score to just these names and these scores, you would see that Davis and Smith would be considered outliers in this data set, almost like, it's almost like a subset. Well, it is a subset of the data. But even then you could apply the Z-score and go, all right, these two clearly are outliers amongst almost all the outliers. And so
right. Yeah.
Yeah. So then you could take this and go, hey, we're going to spend today and we're going to hammer Smith and Davis and we're going to see what's going on and why their scores are so much higher. Something to keep in mind with this is it's not a set it and forget it type of thing in terms of like the risk weights that we assigned. You might dig into this and then go, oh, well, Smith has a 5.43 or this given transaction so high because we assigned this a 10 out of 10. And okay, now that we understand the data a little bit better, that is a common occurrence. We know there's controls in place for that, et cetera. We misunderstood the risk. Maybe it's probably closer to a 6. And so it's an ongoing evolutionary type of project.
But that's part of the process of understanding the data as well, because you might get some false positives, which is what you're describing. And then we can also go back and ask management what mechanism they have to screen for that and to allow for that or correct for that. But the other thing that comes to mind too is when you're thinking in terms of the risk appetite, and I know that's a big struggle for auditors as well, we can certainly also, as we get to know the data and we work with management, is to say, okay, anything over that threshold, whatever that number happens to be, we're going to give it a second look. And we can even have a tiered approach, right? Above a certain number, audit will look at it. From that number to another level, maybe it's going to escalate within management ranks, and then below that is, okay, those seem to be within the range of acceptability. But we can start to see how this becomes a very living mechanism to monitor and to escalate as necessary.
Yeah, absolutely. And the thing that's a good point is, especially, typically maybe the internal audit team develops this, they hang on to it for a little while, and then maybe they hand it off to management. Not uncommon for any kind of continuous monitoring solution. The thing that I've seen happen a fair amount that's at least worth noting is once you pass it off to management, you need to have some kind of cadence to go, hey, what did you find? How's it working? What do we need to change on our end? Instead of it just like, hey, dump it off with them, and if it blows up one day, let us know, we'll go in and fix it. But so you need to have that kind of communication in there, embedded within the process, so it's not just throw it over the fence, set it, forget it kind of thing. You want to be able to go back and tweak it based on what they're seeing, because eventually what'll happen is they might look at it and go, oh, this is cool, and they'll use it for a little bit, and then eventually they go, well, we got busy and we just stopped and it didn't work the way we thought it was going to. So instead of coming back to you and seeing how we could make it more effective, we just stopped using it. Like that's not uncommon at all.
Right. Yeah. Now, one of the things that as I was thinking about the data and how the model behaves is that because it uses standard deviations and averages and so on, it is going to also move, because right now we're dealing with a lot of inflation, for example, right? Airline tickets have gone up, and hotels and travel in general. So if you look in terms of how much organizations are spending, those numbers will move up as well with inflation, but this allows for that. So one of the things for our viewers and listeners is to understand also that this has the flexibility to adapt your organization based on those. If you have a fixed threshold where you want to look, then you need to make that adjustment. But other than that, this is really a living type of a mechanism that can really grow with the organization.
Like I said earlier, I figured you would find a better way to say something than I did, and you just did it again. Next time I do this, I'm definitely going to make that point. I appreciate that.
Sure.
All right. I want to hit on one more thing. And that is, again, once you have the results, being able to take them and do extra with them, or to be able to maybe even do extra with it and then come back to the analyst and go, hey, can you add this? Can you tweak this? Can you make this a new rule? And so one of those things might be, hey, we're looking at this score, these transactions based on this one score. But I know, like if I see, going back to our example with those three tests, I know that if I see for the same transaction, if the one single transaction was at a casino, so if we filter on our casino transactions, it was also on the weekend or holiday or off hours, et cetera. And let me zoom out real quick. And that transaction, so we have a casino transaction on the weekend where they took cash out at the ATM. So to me, that if you combine those together almost, and you go, look, if we see somebody taking cash out on a weekend at a casino, if we see the combination of those three, that's something we want to flag. And so you could even like look into that yourself and kind of validate it and go, yeah, we found something. That's something we need to keep an eye out for. And you could go back to the audit team, the analytics team, and go, hey, can you account for that each quarter going forward so that I don't have to go in and manually look for those? And the combination of those, you look at like round number transactions on holidays or round number transactions the day before a holiday or something like that. It's not uncommon to see where someone bought a gift card on Black Friday or something like that, or Mother's Day was recent. So you went and bought a gift card for your mom for Mother's Day and you put it on the corporate card. You can have those built in there as well to account for those.
Excellent. So Trent, as we're looking at in terms of all of these dynamics and how we go about building it, what are some of the skills and how do we go about getting the skills that we need to be able to build this and sustain this?
Yeah. So this is not something that's going to be best done in Excel. Excel's a great tool to start with if you don't have an analytics background, because it can do, for a couple of reasons. One, it can do a lot. Two, the user community is huge. There's no Excel question that you have that hasn't already been asked on the internet and that 30 people haven't answered 30 different ways. So Excel's fine to start with. It's just not very scalable. And so I'm trying to answer your question directly instead of coming all the way back to the very beginning. But you have to start with some kind of strategy. And so let's say the strategy is, hey, we watch this webinar, we want to do this thing. The next piece is now knowing that Excel is not going to be able to really do this. Reach out. There is a list of tools in the PDF that was sent out. There's some free tools in there, or I think it's all the free tools. Some of those tools can handle it. NIME in particular would be able to do this. So you can reach out to them. Also reach out to some of the other tools that you're probably familiar with. I won't mention them by name, but some of the other vendors, and go, look, this is the thing we want to build. We know we need a more robust tool to do it. Help us understand how we can do it. Like, take them for a ride and get as much free information as you can from those people until they go, look, we got to sell you, you have to pay us for this at some point, you know? So I highly recommend doing that, as well as a lot of those will offer free trials. And so you can do, some of them are, trying to think of the range. I've seen 7-day trials all the way up to 30-day trials. I've made this mistake. New tool comes out, looks really cool, has a trial, download it. It's got a 7-day limit on it. It's day 4, and I realized I didn't bake in any time to actually use the tool. And so if you're on this journey, be sure to block off the time. Hey, we have a 30-day trial. I'm going to block off a solid week and a half, 2 weeks, whatever you feel like you need to actually learn how to use it some. And so that's where you could start. Again, within those tools, though, you want to make sure they have a strong user community. And by that, I mean, you should be able to type in a question or Google a question and find the answer relatively easy. And then from there, most of these tools, I'm trying to think if all of them do, I'll say most, they have some kind of online training, step-by-step process that goes, this is how you import it. This is how you import data. All right, these are all the functions, and we're going to practice using the functions. And these are how you join tables. And this is how you join a table. And here's a video tutorial. Here's a text tutorial. Some people have like online chat help that you can use, call centers, etc. And so I think that's probably the longest winded answer I could have given you, but that's where you could, somewhere in there is a starting point. Yeah.
No. I appreciate comprehensive answers. So no worries, no problem at all. Now, and another thing also, you're generous enough to also share some principles of learning and acquiring some of these skills that those who are watching this webcast will also receive as a PDF that they'll receive when we're done with today's session. So that's another way that we're also going to continue the learning process even after this program is over. So this is very good. Thank you very much, Trent.
Absolutely. Yeah, it's I think 10 steps. And so I've applied it strictly to how to learn analytics. And so you can follow those principles to help learn it and learn it quickly. A lot of times I see where anything that's new can be hard. The example I always give is I've taken multiple foreign language courses and classes, Spanish, that's the only one that's sticking out to me now, Dutch. And then what happens is I get to prepositions and then I lose it. Like once we get to Italian, that was the other one. Once I got to prepositions, I lost it. But knowing red is rojo, that's easy. And so anyway, there's a point where you'll get to and you'll go, this is easy, easy, easy. Oh, now it's hard and I quit. And so this framework, these principles that are in the deck will help you get past that initial kind of wall and push you over there.
Yes. This is wonderful. And another benefit of that is that it helps you avoid the frustration that can come into play after a while when you start and you realize that you get to this point where you are stuck to some extent. This guides you through with these 10 principles. So thank you very, very much, Trent. So I really appreciate you sharing this and the demonstration, of course, which has been very, very helpful, helping us not only hear about it, but actually see how we can do this. So thank you very much. So we're going to turn now to a quick message from one of our colleagues here. Kelly is going to say a few words for us.
All right. Well, thanks, Trent and Hernan. We really appreciate it. Now, to our viewers, if you have any questions, be sure to enter them now in the chat panel right on the right of your screen. Now, before we get to the Q&A, I'd like to tell you all about Audit Pro TV. Audit Pro TV is subscription-based, on-demand CPE learning that's effective and engaging. A one-year subscription costs less than a 3-day classroom course, and it allows you to gain access to a library of internal and IT audit, fraud, risk, and cybersecurity learning at any time and from anywhere. Visit acillearning.com to learn more about Audit Pro TV and request your free demo to see what the fuss is all about. All right, let's get to these Q&As. First question. This one is coming from Ahmed. He wants to know, where should auditors with limited resources start?
Yeah, so Excel, we hit it on a little bit. Excel's a great place to start. And then specifically within that, again, why I like this example, pivot tables, take 20 minutes, watch YouTube videos. Excel lookup function, so either VLOOKUP, XLOOKUP. I would start there with one of those two, doesn't really matter which one. People argue one versus the other, mostly the XLOOKUP. That's fine if you want to start there. And then from there, it's really about being able to search for the answer on the internet that you need. And so, for example, when we needed to concatenate, we need to use that concatenate function. If you can search for, whatever, how to combine 2 columns in Excel, there's going to be pages on Google that say, here's the concat function, here's how it works, there's a link to a video to show how it works, here's other ways that you can use this to make it work, here's VBA that can do something or whatever it may be. And it sounds ridiculous to say this, but being able to Google the thing that you're looking for is pretty critical. If you talk to enough programmers, there's a bit of a running joke that they don't really know, well, they do know how to code, but for the most part, they just take what somebody else has already written on the internet, copy it, paste it, tweak it to work for them, and then plug it in. So being able to search for the answer, which comes with a bit of data literacy. So it's one of those things, it's not linear in how you're going to learn it. You'll learn a little bit, come back to to the beginning or somewhere else, and then learn as you go. But you just have to keep trying.
This is also very important because it also helps from the perspective of realizing that organizations that have limited resources, there are so many free or low-cost resources available on the internet that they can leverage as well. So we are in a very good point in history where knowledge is available very readily. So that's, again, another thing to add to your point, Trent. So we have a question from Judy. And she's asking, are there instances where z-scores should not be used?
So it would need to be within a normal distribution. So if you look up normal distribution, you'll see what I'm talking about, but that's where it makes the most sense to use it. I'm trying to think transactionally though, outside of that, where it might not be. And maybe the best answer I can give is I've shown that technique to a forensic accountant who has a data analyst on their team, and they embed it within all of their fraud procedures now. And so I haven't come across an area where it wouldn't make sense, especially if you think about, it might take you 10 or 15 minutes, maybe the first time you do it, if you go back and watch the replay, et cetera, and apply it, maybe it takes you 30 minutes. But once you get the hang of it, those, basically 3 steps, you can knock it out in 5-10 minutes. And so, I often will tell people if it takes, if it doesn't take very long, just throw it in there and see what pops out.
Okay, Ben wants to know, Trent, have you written any books that they can order on Amazon or anywhere else?
No, I tried for about 5 minutes and then went, That's not for me. So maybe one day I'll sit down and do a bunch of voice recordings and pass it on to a fantastic ghostwriter or someone that can do that. But no, I don't.
Okay, that's a good idea, by the way. I think you should do that. Bay is checking in, and she wants to know, how can auditors also working in external landscape apply these concepts?
How can auditors also working in external auditors? I mean, you can still use it and then use that to ask the questions. The problem is going to be in dealing with, does it fall really within the SOX scope that you're looking at, to be looking at those transactions in terms of like, you're going to have to work with the partners and for your firm and understand, like, does it make sense for us to look at this this way, especially if, like what I've seen in the past is people will apply analytics to some kind of external audit thing, and then like procedure, and then like, hey, it's great and wonderful, we did this. And then external comes in and looks at it and goes, yeah, that is cool, but we can't rely on it because you didn't test the control. You test it using analytics, so you're inferring that the control is operating effectively, but you didn't actually test the control itself. And so overall advice when it comes to anything, especially SOX procedures wise, if we're talking analytics, I would get sign off on the partner before actually executing on it. A lot of people can mistake analytics for automation though. Automation's fantastic and you can use it anywhere and everywhere to be more efficient. So that right now, today, relative to SOX, it's more about efficiencies with automation than it is necessarily with testing 100% of the population. We are hoping and we're working with those big four firms and other ones to help understand, like, if we do this, can we do this? You know, are you going to accept the results depending on what those are? Do we need to do additional procedures, et cetera? So definitely hit those up. And then let me come back. I realized, I think I know who Ben is. And if he was recommending, if you want to book recommendations, data wise, there's a couple of fantastic ones. More to management level is going to be data teams. It's a big one. It's like 12 to 16 hour read. Really, really good though. And then there's a recent one, data strategies, and I'm not recalling the author. Jesse Anderson wrote data teams, but data strategy, again, it's about a 16-hour read, but and it's a bit verbose, but it's a very good one. So those are good for more, again, strategy, planning, running a program, et cetera. And then as far as actual execution, like within a tool, there's plenty of them out there from O'Reilly. So if you just type in name of your tool plus that, that should be probably all the resources.
Okay. Romad wants to know, can we combine this technique with other techniques such as Benford's Law?
Yeah, Benford's Law has like the standard deviation piece within it. And that's actually one of the other workbooks that we commonly show is Benford's Law. But in terms of combining them, I don't think you would combine them, but for most tools, Benford's is like a couple of clicks of a button. And so I would use them in conjunction with each other on the same data set as part of the typical stack that I would kind of recommend. A lot of times when we work with clients, like we'll implement these set of tests. So Z-score might be one, Benford's might be one, and go, hey, when you get a data set, just pump these through, see what the results are, and come up with some questions.
Okay. And Kyle says, if an organization has a data analytics center of excellence that they use, how would that impact their data analytics program?
Yeah, so if you think about that, like, let's say you have a center of excellence, a data center of excellence, and they do all the data analytics for the organization. A couple of things are going to happen. One, if like when audit reaches out to them, especially if it's like maybe a newer function, and they go, yeah, we really don't have a whole lot going on right now anyway, so we'll do the thing that you need. Eventually, sales, marketing, some operational folks, their requests are going to get prioritized over the audit request. And so I would highly recommend at least having a really good relationship with those people so that they go, all right, well, I know this, it's not necessarily the highest priority, but let's knock it out real quick for Kyle. So that's something that I would recommend, definitely developing the relationship, but eventually it's not going to be able to scale. They're not going to take on every single project that you have they aren't going to be able to, hey, we have this, whatever, payroll audit coming up, and we need these results within the next 3 weeks. You may or may not get them on time. And so you can definitely use them. I would leverage them to the extent you can, if nothing else, to build out the case for more resources to bring like an analytics full-time resource into your group. So you can say, hey, look, almost like race to get them the center of excellence to tell you no, like we want this, and they give it to you and go, great, we want this, 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 and this. And when they come back and say, oh, we can't give you all of that right now, that's maybe when you go to leadership and go, look, the center of excellence did this thing for us. These are the results. It's great, fantastic. We can't scale it because they have other priorities they have to work on. Can we now go hire our own full-time analyst to be able to execute on all these other analytics that we need?
Okay. And Gordon wants to know, what's a common mistake that you see audit teams make when implementing analytic programs?
Typically, it is, hey, we bought the tool, but nobody used it. Or we bought the tool and we don't know what to do with it now. And so tools are great. You have to have them. But I was just having a conversation with someone about this today. You have to start with some kind of strategy. And even then, that's where you can see a lot of people make mistakes. But you have to have some kind of strategy, some kind of roadmap put together. And then as part of that is a tools evaluation and buying the tools. But way too often I see, hey, we have a team of 10, so we bought 10 licenses for this software and we spent a bunch of money on it because we're going to be data driven. It's not going to work like that. Of everyone I've ever talked to, I have not seen a single audit department that has had every auditor use the tool that they bought. People just don't want to do it, and it's hard. And so, again, people get to that wall quicker than others, and they just want to stop. And so start with a strategy, and then work from there. Identify it. In strategy, you can break it down to people, process, technology. If you don't have the people that are going to execute within the technology, then it's not going to make sense. If you don't have a strategy over those two, then it's not going to make sense and it's not going to work.
Okay. And our next question, how can Tableau be used in this?
Yeah, you can use Tableau for, obviously it's a visualization tool. And so you could show those outliers within Tableau. That might drive it home more for people to understand the results. If we're talking about Z-score, you could do it that way. Similarly, with these higher risk transactions, you can just throw it in Tableau and visually show like this is the highest ranked transaction. My personal preference is not to develop a lot of the, we'll just call functionality or the thinking, the scripting within Tableau. I like to do it in the back end in some of the other tools, and then really try to limit the amount of calculations in Tableau so that it's easier on that piece of software. A lot of times it might not matter. There's we deal with sometimes 3 to 10 million transactions. And when you load all that into Tableau and then you have to do all these calculations, it bogs it down pretty heavily. And so you can keep Tableau pretty simple. You can keep it simple though, and just, show, hey, these are the highest risk ones, and even show it over time.
All righty. Well, thank you everyone for your questions. We've run out of time here for this webinar. We do want to thank Trent and Hernan for such a great webinar. Fellas, are there any final thoughts before we leave?
Well, as for me, I think that this is a great demonstration of a very versatile tool, how the model can be used and adapted to different needs of organizations. So I think it's something that definitely from a cost perspective, just about everyone has Excel, and the walkthrough that you provided was very, very helpful. So thank you very much, Trent.
Yeah, I'll say just try. Just try. Take 20 minutes, watch videos, give it a shot. At least just know pivot tables. It'll save you a ton of time.
Well, thank you for joining us, and we look forward to the next webinar right here with ACI Learning. Have a good one.
Thank you for joining today's webinar. You will receive a link to the webinar recording delivered to your inbox. See you next time.